In both relative and absolute terms, the managed solutions performed well in February. All three were in positive territory for the month, but from a relative perspective, global managed and global cautious performed well, whereas growth underperformed mildly. Absolute returns were attractive on the back of what is probably best described as a relief rally, as a consequence of a last-minute deal to extend the current Greek bailout. Global cautious was up 1.6%, managed 3.6%, and growth 4.9% net of all fees. And year to date, the funds are all also in positive territory and in line or ahead of benchmark net of all fees. The main story for the month was Greece's protracted negotiations and an end-of-month muddling through, which culminated in an extension to the bailout for Greece, which was due to expire on the 28th of February. Indeed, towards the end of the month, fears over a Greek exit from the Eurozone had largely dissipated, but this was because of an 11th hour deal agreed between the Greeks and the European institutions as Greece submitted a somewhat vague list of reforms that it will commit to undertaking over the coming months in exchange for a 4-month extension to the programme. The dynamic since Syriza came to power has been fascinating, with early indications suggesting that the Greek public had appointed masterful negotiators to represent them at European level. The reality, however, is different, and it's interesting to note the amount of ground Syriza's had to concede to the Germans over the month. The party could well find itself coming under increasing pressure from the electorate to deliver on the heady promises they came into power on the back of. On the other hand, European politicians know how toxic a prospect Greek write-offs would be domestically in the more fiscally responsible states. The UK equity market returned 3.3%, with small cap outperforming large cap over the month. The funds have a decent weight to the UK, which aided performance, with the largest impact in the higher risk and return funds at the higher numbered end of the range. Our UK equity managers, who've had a phenomenal run of outperformance over the past year, mostly underperformed, weighing a little bit on performance. In local currency, Europe also performed well, but a large proportion of that was given back by the euro weakness against the GBP. Fixed income markets didn't perform particularly well. The gilt market was down nearly 5%, which is a reversal of January's moves largely. The funds do not have a large allocation there because we think it's expensive. Our other credit performed well, but still weighed on performance as a result of sterling's strength in the month, particularly our offshore credit exposure. For example, US high yield, global convertibles modestly negative, whereas emerging market bonds were down 2% over the month in sterling terms. So there have been no major changes undertaken this month to the holdings of the managed solution. We've got a broad allocation to global equity, augmented with exposures in Europe and an underweight to the US, as well as a couple of more focused strategies, infrastructure, Copenhagen Global All Cap Contrarian, and within the fixed income buckets we're underweight sovereigns and overweight a variety of areas of the credit spectrum, including investment grade, high yield and loans. We retain a reasonable cash balance as we think it's fair value compared to government debt, and also it's useful to put to work as and when valuation opportunities present themselves. Going forwards, we expect to see a continuation of the broad themes we've seen in the markets over recent months. We still think valuations in equity markets, while through fair value, are not exceptionally expensive, particularly in a world where you've got consumers starting to wake up, you've got continued extraordinary liquidity measures being put into the markets by the European Central Bank and Japanese Bank of Japan, for example. Against that backdrop, you've got GDP just starting to improve, you've got consumption looking like it's starting to pick up a little bit, whilst on the back of a de facto tax cut, thanks to the significant fall in oil price in the second half of last year. So we're broadly constructive on the equity market. We also see a world, as the US data improves, where the chances of an interest rate increase in the US starts to become a reality. We've started to see the action in the bond market on the back of that. We don't think that the interest rate is going to fly up, but we do think that on the balance of probabilities, interest rates would increase, which makes high quality sovereign bonds relatively expensive as far as we're concerned today, and as a result we try and avoid them where we can. Still good opportunity in credit markets. Spreads are reasonably tight from historical standards, not at all-time lows today, but they're not particularly exciting, but they still represent a valuation improvement over and above what we can get in government bonds. We like positions like infrastructure, like Contrarian, all cap position, and also our gold miners, which we still hold in the portfolio. We're looking for decent gains from those positions still. So going forwards, a continuation of much of the same. We expect to see more geopolitical risk, more political risk out of Europe as well. But again, a valuation-driven, well-diversified portfolio, we expect to be well positioned to ride out the bumps and deliver the sort of returns our clients expect going forward.